Good evening, everyone. This is Prajakta. Um, in the meanwhile, others join. What I will do is introduce the topic for today. So, welcome to the NGEN Markets webinar. The topic for today will predominantly revolve around comparing mutual funds with their respective benchmark indices. So here, what will we do is we'll choose a category from the SEBI categorizations of it on NGEN Markets. Then we will understand how we can add it to the compare section, where we will analyze as to what is the alpha that is generated by these mutual funds over the benchmark, understand what is the beta of all of these mutual funds with respect to, of course, the benchmark that we have chosen. We will understand how do they correlate with respect to their NAV movements with the benchmark. And finally, then we will move ahead and understand if a SIP is done in these mutual funds, what will be the returns that would be generated by it. Next, we'll move towards point-to-point analysis, wherein we'll understand if a lump sum amount is invested, or for that matter, if there are multiple scenarios, let's say a Fed rate hike or something like a union budget scenario, how will be the performances of these mutual funds in those scenarios? That will be the point-to-point analysis. Then we'll move over to rolling returns analysis, wherein we can see within a rolling window of, it could be varying holding periods, it could be 260 days, which is equivalent to 1 year, or even others. So depending upon the years rolling analysis you want to do, can alter the rolling windows and check as to how many of these funds have generated positive returns in that specific time period. Next, lastly, we'll move over to the drawdowns analysis, which tells you what is the strength of a fund to recover from a loss. Finally, we will then throw the forum open for a Q&A session, wherein you can get all of your questions answered from our team. So let us now begin. Let us now move over to NGEN Markets. This is specifically our terminal where we'll be working on. So first of all, we have to select a specific category to load funds from, right? So there are a couple of ways of doing that. First, what you can do is go to the funds section, which is the fourth section on NGEN Markets, choose a category. So let's say for today's webinar purpose, I'm choosing a large and mid cap category. I just choose large and mid cap and click on close. All of the funds which come under this category get loaded right here. Okay, but these, as you can see, it's a large list of funds, multiple funds. You would like to specify some filter parameters to at least screen them further, right? For that, we have provided some filter parameters right here. So let's say we do not want very young funds who do not have a very high reporting history for analysis. So then what can you do in that case is specify the minimum age parameter. So let's say this minimum age is 4 years. Next, moving ahead, we can specify some minimum AUM as a criteria. So let's say, let's restrict ourselves to at least 500 crores should be their AUM, so that they qualify for our further analysis in the compare section. So I put 500 here. After that, let's say I want to specify a minimum returns that were generated by the mutual funds that I would like to screen to, let's say, 1 year returns to, let's say, 10%, which is a pretty modest return that way. So for that, I specify minimum period. So first of all, 1 year, and minimum return in this 1 year should be at least 10% or above. So I specify 10 here. Once I am done with applying filter parameters, I just click on apply. Once I click on apply, the long list that was previously there has now gotten shortened to only these many funds. Of course, there are further filter parameters here like Sharpe ratio, historical value at risk. You can definitely go ahead and specify those. But for the time being, I'm just specifying these three filter parameters and clicking on apply. Now, I can see that there are a lot of junk columns here, which is, net YTM, average maturity. These are specifically not relevant for equity, asset class mutual funds that we are really choosing from. In that case, to just clear all of these columns from our view, what we can do is click on this drop down and choose on only equity columns. This will typically remove all of those columns which are not really relevant for the criteria that we are choosing from, right? And now you can see all the relevant columns are only appearing. So Sharpe ratio is here, standard deviation, which is a measure of risk, is here, Sortino is here, of course, and the return periods are obviously here. So these are calendar years. And if you scroll towards your right hand side, these are 1 month, 3 months, 6 months, and of course, so on return periods, which are coming here. Next, of course, now we would like to take all of these to the compare section for further analysis. So how do we take that? One option is to click on the balance icon that you can see right at the left hand side of each of these funds and add them one by one to the compare section. But in another way, alternative way, is to click on this, add top 50 to compare. So up to 50, if there are funds in this section, they will get automatically added in the compare section by clicking on just this button in a single click. So I've just done that, and all of these 16 funds have gotten added in the compare section in a second, right? So that's how you can take all of the screened funds from the fund section to the compare section. That's the first way of doing it. Before proceeding, I will just show another way of doing it. Alternatively, what you could have done is, because we were to select from large and mid cap as a category, and let's say you did not want to apply any of the filter parameters, you could have directly gone to the category averages and looked out for the large and mid cap category right here. So as you can see, each of the subcategory of as per the SEBI classification is listed right here. So let's say you're finding it a little difficult to locate the category that you're looking for. Just untick all the others. So we are currently looking from asset class of only equity. So I just untick everything else. And now only equity asset class subcategories are listed. And I can see large and mid cap is right here. So there are total 27 funds currently trading on Indian markets in large and mid cap as a category. Right? I just have to click on this and I can see all of these 27 funds listed right here. If I just click on this, which will transfer all of this entire category of this large and mid cap to compare section, I just have to click on this. All of this will get added in the compare section. However, a point to note here is you will not be able to apply any filter parameters here. Right? So let's say you wanted to specify some filter parameters that we just did in the screener. You have to follow the process wherein I went to the screener first. I chose the category. I applied some filters. I clicked on apply and then take it to the compare section. So that's the way to do it. Right? Now, once they are in the compare section, you now can specify an index to compare it with. Because this is a large and mid cap fund, we will take a benchmark of, let's say, a Nifty large and mid cap index for it. So I'll just search for a Nifty large and mid cap index. So that's right here, Nifty large and mid cap 250 as a benchmark to compare the performances of these funds against. Once this has gotten added, I can see that if I scroll to my right hand side, there would be some pink color coded columns right here. Okay, these are specifically the columns which indicate what is the relative performance of these funds with respect to the benchmark that we have chosen right here. So relative to this benchmark, what are the performance statistics of all of these funds? Now, before making this analytics, you need to ensure two things: that the start date here, which is appearing right here, and the start date right here, which is hello. Okay, so the start date appearing in the pink color coded columns. Okay, these two are same. To ensure that, firstly, we will change the start date right here. So let's say we are doing this analysis from 2019, let's say 1st of June. So that will be close to 4 years before, right? I'll just choose, let's say 3rd of June, because that was the first working day. I choose this as a start date for these relative columns. I need to ensure that here also I choose the same start date. I go on the settings button in the returns column. Once I go there, I click on the start date and I choose it as 2019, 3rd of June, and I click on go. June 2019, 3rd of June, and click on go. Okay, so now what this says is we have chosen a common start date and now it's a fair apples to apples comparison. Once this is done, what we can then do is head over to the right hand side and see what is the annual excess that is generated by these funds over the benchmark under consideration. Firstly, what you can do is just sort this in an ascending or descending order. So currently I've sorted this in an ascending order, so lowest to highest. So I can see that these funds from Invesco India Growth Opportunities Fund till UTI Core Equity Fund, all of these funds have actually generated a negative excess return. That means there's no alpha basically, right? There's no positive return over the benchmark. On the other hand, all of these funds, let me just now sort it on the basis of a descending order. So I can see now all of these funds, which is starting from access growth opportunities to Edelweiss large and mid cap funds, all of these funds have managed to generate an excess return over the benchmark. So that clearly means that all of these funds have managed to outperform the benchmark with respect to returns. Only returns under consideration, of course, from a start period that we have currently chosen, 3rd of June 2019 onwards. Okay. Now we will now understand what beta parameter here means. So what beta means is what were the movements, what was the sensitivity of the movements of these mutual funds with respect to the benchmark. So that typically is a measure of the risk. So let's say if the benchmark here moves up by, let's say 1, then how much will these funds move? So typically if the beta is higher than 1, it typically means that the funds are riskier than the benchmark under consideration. But as we can see, all of these funds under consideration have reported a beta of less than 1. Everywhere, as you can see, is less than 1. That means all of these funds which are actively managed, all of these are actively managed funds, have risk which is lesser than the overall benchmark risk. That's the meaning of beta right here. Now let's move ahead to the correlation column here. What correlation means is how coordinated are the directions of these mutual funds with respect to the benchmark. So by coordinated direction, I mean how coordinated are their NAVs. So let's say if the direction of Nifty large and mid cap 250 as an index goes up, access growth opportunities will also go up. And how closely will it go up? So it will go up 89% of the times, right? On the other hand, if we see this, it is very tightly hugging the benchmark benchmark movements, right? So as you can see, Invesco is will move up 95% of the times. On the other hand, large access growth will move 0.89% of the times. That's the correlation analysis. How closely are the NAVs of these funds going to move with respect to the benchmark movements? That's about the correlation analysis. Once this is done, we can now head over to monthly SIP and point to point. Just before that, what I will do is I will now add, we have seen a comparison with respect to a benchmark. Let me now add a category average, which is an indicator of all of the 24, 27 funds in the large and mid cap category, and how do these funds which we have just screened compare with the category average overall. For that, all you need to do is head over to the top panel, which is add other items. And you can see a historical category averages section right here. Here, I will just add large and mid cap as a category average. So just have to search for large and mid cap. And once this will get added, it will get added, by the way, as a row item, just somewhere in between these mutual funds. So I can see category average large and mid cap has gotten added here. And now let's say I want to check which of these funds have managed to beat the category average with respect to, let's say, CAGR that was generated by these funds. Okay, so for that, I'll just click on CAGR as a column heading. When I click on this, it will get arranged in a ascending order. So it has gotten arranged in an ascending order, lowest to highest. And I can see category average somewhere appearing here. So this line is the entire category average line. So all of those funds which are above this category average line, category average row, tells that these funds have not managed to beat the category average with respect to CAGR under consideration. All of these funds managed to beat the category average with respect to CAGR under consideration. The category average CAGR, by the way, was 14.25%. Of course, during this period that was under consideration. So the period is 3rd of June 2019 onwards. And all of these funds recorded higher CAGR than the category average itself. So that's definitely a good thing about all of these funds taken together. Okay, now let's move ahead to the second part, which is monthly SIP and let's say a lump sum part. So let's say the client who you are, trying to advise some funds or trying to recommend some funds comes to you and tells you that he wants to do a SIP analysis, SIP investment in a fund from the large and mid cap category. What will you do is come to NGEN Markets compare section, load the funds, and then head over to monthly SIP. You will put a notional installment amount. Let's, for example, consider 10,000 per month installment put in. when you put 10,000 monthly in, let's say, each of these funds from, let's say, a start date. Let us all consider June itself, June 2019 itself, so that we can see how do they perform from June 2019. And end date can be kept as yesterday, so 1st of June 2023, the closing price is available. And click on Run SIP. Once you click on Run SIP, you can see the XIRR and the final value columns appearing right here. So let me just sort this as per XIRR. So I can see that the highest XIRR was generated by iPru Large and Mid Cap Fund, right? Of course, during the period that we have chosen, the XIRR was 21.29%. And if an installment of 10,000 each month was made, the final value would have been 7,28,000 and something, right? So that's the highest even indicated in this chart, bar graph manner. So I can see iPru Large and Mid Cap, which is the final value of 7,28,000. Closely following to that is HDFC, SBI, Quant, and all of that. The XIRRs were these. Let's say which was the lowest. The lowest was Invesco India Growth Opportunities with an XIRR of just 13.88. So that's the monthly SIP analysis that you can do in the compare section. Of course, this is on all of this list of the funds. Let's say you want to do a monthly SIP analysis on only singular fund and send that report to the client. What you can do is, let's say you have chosen this fund, which is the highest XIRR generator during this period. All you need to do is click on this icon right here. It will open up only this fund ka SIP analysis in a new tab. Okay. For that, just choose the start date. So let's say 2019, 3rd of June. And 1st of June 2023, with an installment of, let's say, 10,000, and click on Run. So when we run this, so ICICI Prudential Large and Mid Cap Fund, that's the SIP analysis on this fund. The XIRR, as you can see, is 21.29. And what is an additional benefit with this is the reports that can be generated out of this. So if I just click on this 2-pager detailed SIP report, I can click on Create PDF, and a detailed 2-pager PDF will get downloaded. And then I can send this across to the client. Of course, the highlight is going to remain. It will be co-branded. Left-hand side, your logo will come. And then you can show that what was the total invested with a 10,000 SIP and what will be the final value. What this graph really means is how did your invested value keep on growing? So that's of course fixed. So step up 10,000 each month. And then what were the NAVs? How did they change? And accordingly to the NAVs, how did your invested value of the portfolio changed? That's the blue line right here. This is the detailed 2-pager PDF report. This will also have the monthly changes in NAVs and of course the values month on month. That's a detailed 2-pager PDF report. Okay, that's about the monthly SIP reporting point of view. Now let's head over back to the NGEN Markets terminal, and then let's say we want to do a lump sum investment analysis. So let's say the client who had come to you seeking for some funds in large and mid cap category wants to now understand, if I do a lump sum investment, how will my investments perform? So then in that case, you directly head over to the point to point tab, which is right here in the compare section itself, third last tab in the compare section. So it says a point to point analysis. What this says is there are 3 options right here. Firstly, lump sum investment value. Let's say I want to give a notional value of, let's say, 5 lakh to the client. So I want to show how will the investment perform if a 5 lakh notional value is put from a point to a point in specific funds. So let's say this is the period that I've considered, right? 3rd of June 2019 to 1st of June 2023. That's the period that I had even considered for SIP with a 5 lakh lump sum amount. The highest would have been given by Axis Growth Opportunities. So here is a starking difference. So if it would have been in SIP, the top generator were ICICI Prudential, and in case of lump sum, it is of course Axis Growth Opportunities Fund, of course from the start date to a start date. And these are the values. So 5 lakh would have been 9,77,000 and so on, right? The lowest would have been given by Invesco India Growth Opportunities, which is just 7,87,000. That's of course in rupee terms. Now, let's say you want to understand this in terms of annualized percentage. All you need to do is click on this annualized percentage terms, and then we can see annualized what were the returns by these funds. So of course that was in rupee terms. This is in percentage terms. Now, what you can also do in point-to-point analysis is create some scenarios. So for today's webinar, I've already created some scenarios wherein I just have to click on the start date and end date, I just choose the start date of the scenario and end date of the scenario. Typically, this first scenario is the COVID lockdown scenario that I've considered. So 2nd of March 2020 to 31st of August 2020. That's typically 4.5 odd months, wherein lockdowns were in place, and what were the performances of these mutual funds in this specific scenario. Now, as you can see, this period is typically less than a year. In that case, what you should ideally do is click on absolute button and see what were the actual returns of these funds in these time periods. Because these are less than 1 year periods, you should ideally see your absolute return. And now I'll just click on sort, and I can see quant, large and mid cap fund, in spite of being testing times, had generated a positive return of close to 9.10%. On the other hand, some other funds from the same category, large and mid cap, actually generated negative returns. That's the COVID scenario. Second, what I've considered is a financial year scenario. So 1st of April 2020 to 31st of March 2021. And in this financial year, what were the returns that were generated by these mutual funds, same set of mutual funds, right? So that's the second scenario that you can build. Of course, all of this is customizable. You can choose whichever start date and end date that you want and build certain scenarios like this. The third scenario that I've taken is the Russia-Ukraine war, specifically the inception of the war, right? This is when the war actually started, and invasion started, and there was a lot of volatility in the markets, and which is typically even reflected by the performances that we can see, right? Every fund, each and every fund from this large and mid cap category has generated negative returns. This is the third scenario that I've built, and then you can gauge as to what how volatile the markets were in these times, right? Next scenario I've taken is of Union Budget 23. So I've taken 1 week prior to the budget, 1 week post the budget. Budget was announced on 1st of February 2023, and then in this budget scenario, Access Growth Opportunities generated a return of 3.13% in this scenario. That's how you can do a point-to-point scenario analysis. This can also be used for lump sum analysis that I have already explained. Okay, now once we have done this return specific analysis, let us move over to drawdowns analysis. Now, what drawdowns analysis will tell you is, okay, returns analysis is fine, but tell me how these funds perform or recover from a loss when they experience one. Because generating returns capacity is there, that's all is fine, but when the NAV start falling, clients become jittery as to should I hold or should I not, should I liquidate my position, what is the action plan, what should I do, right? That's how drawdowns analysis will help you. So just head over to the drawdowns analysis section, just choose a start date. Let's say I am just maintaining 3rd of June 2019 everywhere in analysis today. So let me just maintain here as well. So 3rd of June 2019. And I can see that from the start date, what were the top 5 drawdowns that were experienced by these set of funds. Okay. First of all, I can see the sizes of the drawdowns. So when I click on size, and rank it as per highest to lowest, that is worst drawdown ka highest size to the lowest size. So I can see HDFC large and mid cap had a drawdown of 39.53%, right? And this drawdown took 66 days. So the fund kept on falling 66 days to record this drawdown of close to 40%. Now, let's say you want to dive in further into this, into depth. What you can do is just click on this chart icon. What we can see is these are the drawdowns that we are really talking about. So this is the worst drawdown, 39.53, when the NAV of the fund was 119.27. When this drawdown started was 17th of January 2020, and from that the NAVs fell to 72.13 ka level. When the drawdown ended, this the NAV was 72.13. And when did this end? It was on 23rd of March 2020. So within 2 months, less than 2 months, in fact, the fund fell 39.53%. And after that, after having recorded a sharp fall, the fund took 176 days to recover from this loss. And this loss got recovered on 24th of November 2020. So now what do we mean by recovering from this loss? So that means on 24th of November 2020, the NAVs of this fund reached back to a level of 119.23. And we can, by the way, cross-check this. So I just have to hover on 24th of November 2020 on this chart. So let me just locate 24th of November 2020. Yeah, somewhere around. Yes. So I can see that the NAVs, as I can see, 27th November, the NAV is back to 121.20, which is definitely above the start price, which is 119.27 right here. So that's why the recovery date was specific. Exact recovery date was 24th of November 2020, when the NAV reached back to this level. That's the reason we have mentioned this as a end of drawdown, meaning recovery of this fund. That's the ranking these funds by the on the basis of their size of drawdowns. Now, what we can effectively do is rank these funds on the basis of quickest recovery or the fastest recovery. For that, all you need to do is click on this recovery button and just sort them as per ascending manner. So what I've done is I've just sorted them in the ascending manner. I can see that quant large and mid cap fund recovers the quickest from the drawdown of 31%. Right, this is the drawdown that it experienced, and it recovered the quickest among all of its peers. All of these were its peers. The second ranking fund, which is Access Growth, took 113 days. So that's clearly a difference of more than 30 odd days, 33 odd days in this recovery, right? So among all of its peers, it recovers the quickest, quant large and mid cap fund. So that is one analysis that you can do using the drawdowns analysis in the compare section itself. Of course, you can check the same thing for the second worst drawdown, third worst drawdown, and so on. But as you can see, the magnitude of losses will go on reducing because this was the worst drawdown, right? So 31%, 17% for the second worst, third worst was 14.43%, fourth worst was 13.84%, and the fifth worst was 10.72%. That's, we've just ranked them as per their magnitude of losses. That's about the drawdowns analysis. So we could also do this on a portfolio level. This is on a fund level. If let's say you want to do the same drawdowns analysis for portfolio level, all you need to do is load any of the portfolio, and once you've loaded in the portfolio, just head over to the drawdowns analysis, and this is exactly where you could do the drawdowns analysis. By the way, this feature of portfolio drawdowns was already available. Compare section, that is fund level drawdown feature, was a recent one. That's the reason I focused only on that specific feature in this webinar. But you can do the same thing for a portfolio level also. So this typically brings us towards an end of the topic-specific webinar. If you have any queries, you can definitely unmute yourself and ask, or you can also type them in the chat box and we will answer it for you. Thank you. So there's a question in the chat box. What is cumulative excess? So in
can you get cumulative excess? You mean in the compare section? Yes. So this basically shows the excess return over the benchmark chosen for the total period from the start date to now. So it's the cumulative return of that particular fund versus the cumulative return of the benchmark.
Hi. Can you please explain what is the importance of tracking error ratio and the information ratio?
Sure. Yes, sure. So basically, tracking error is it's a standard deviation calculation, but instead of doing it on the returns of any particular fund, like in this case, Access Growth Opportunities, it actually creates a standard deviation of the daily price difference between Access Growth Opportunities and Nifty Large Mid Cap 250. So, sorry. So this basically means on a daily basis, it looks at the difference in return between this fund and the benchmark, and it calculates the standard deviation of that difference. So, so this basically, the lower this number, that means the fund is moving very closely with the benchmark. And if the number is high, that means it's not moving very closely with it. So for example, if you look at the tracking error of an index fund, for example, it should be quite low, especially if you choose the relative index, like let's say Nifty 50 fund. Let's try a Nifty 50 fund here. Just type Nifty 50 anything. Okay, so Nifty 50 ETF. So if you try that and then change that, so let this come back for a second, yeah. And then we change the benchmark to Nifty 50. Okay, so as we go on, I think it's the second one. Yeah, so here you can see the tracking error is much lower because this fund, the UTI Nifty 50 ETF, happens to track the Nifty 50 quite closely. So the tracking error is generally useful mostly for funds that are supposed to be very closely moving with their benchmarks. For other funds like the funds that actually target a return or try to exploit other opportunities, in that case, tracking error is probably not a useful measure to look at because the purpose of that fund is not really to track.
Outperform only, yeah.
Right. And information ratio is also very closely related to tracking error. It is kind of what Sharpe ratio is to volatility, information ratio is to tracking error. So information ratio, the formula is basically the annual excess return divided by the tracking error. That's basically the formula. So a high information ratio means that in a risk-adjusted way, a particular fund is tracking the benchmark quite closely. So again, I think in both cases, tracking error and information ratio, these are statistics that are mostly useful only if you want that the fund or stock, etc., whatever you're looking at, should be very closely following the benchmark.
The index.
The index, yes.
Okay. Okay, thanks.
No problem.
Oh, hi, sir. Am I audible?
Yeah, go ahead.
Yeah, just a quick question, sir, regarding regarding the rolling returns column. So can you just go there, and I just wanted to know what's the positive there, negative, and the range, which is how it is like. What is it about? Like, can you explain a bit?
Sure, no problem. So in this case, let's stay on the screen. So basically on this case, firstly, what we're doing is we're calculating the rolling return with a window of 260 working days, which is supposed to represent as close as possible to 1 year. But it's a time period that is static. So it's 260 days moving ahead in time, 1 day at a time, during this period. Now, if you actually look at the chart here, there are lots and lots of lines here, each representing one fund. But if you just go somewhere in the middle or just stop anywhere, yeah. Okay, so when we look at this, Tata Large and Mid Cap Fund, 30th of April, 57.53%. So basically what this is showing you is that this Tata Fund on 30th of April, 2021, for the last 260 days, the return was 57.53. And as you move ahead in time, there'll be different numbers depending on what that particular fund's previous 260 days was like. So this is obviously the rolling return for each fund. Now, when we look at this rolling return evolution over time, what this tab does is analyze this chart basically, which is the evolution of the 260-day return over time, which is the rolling return. So when you look at the range, actually, let's start at the high-low. So the high is basically, this is very straightforward because this is showing that UTI Core Equity Fund, the best 260-day return that UTI Core Equity Fund has had in this time period is 100.85. And the best meaning this is the best possible period because we are looking at a daily frequency. A lot of other places you might see rolling returns, but they're calculated on month-end basis. In that case, the middle of the month will always get missed. So what we have done here is taken every single 260-day period in history, and we found that the best 260-day period was 100.85. The worst 260-day period was minus 35.59. So the range column actually shows you the difference between the best and the worst. So this is kind of the variability of the 260-day period. So it can be as high as 100 or as low as 36. So 136% is the range of the values, right? And finally, the positive percentage column. This is quite useful. We actually use this in creating strategies as well. So this shows you that 78% of the time, the 260-day return period for IDFC core equity fund was positive. So this gives you a decent amount of confidence that in most cases, over a 1 year period, I should be okay. Because almost 80% of the time, I'm at least not losing money. So in this case, 78.34 means when you look at all the 260-day periods for this fund over the past time period, start and end date as on above, all of the 260-day periods, out of them, 78% were greater than 0. And you can obviously sort with this column, and you can see some funds have very high positive percentages. So quant large and mid cap fund, almost all of the time, 1 year returns have been at least positive, right? And then you can see the range in this case has also become better. It's not, the range is also not that bad. It's a tighter range compared to 132, what we were looking at before. And obviously you can see the high and low. The high is not as high, but the low is also not as low. So maybe in that case, statistics for these funds, are a bit better.
So and one more thing, I'm
Yeah.
going a bit technical. In the
Sure.
average thing, if we take the period like 2019 1st January 2019 and 1/3, okay, 1/3
Okay.
rolling, and it's
Yeah.
2022 31st, that would be 3 years would be 22 1st January 22. Like this would be the first rolling period, right?
Yes. So you're right. So
So
basic.
so
Yeah. So yeah. Go ahead.
I'll just I'll just explain if I'm getting it correct or not. You can just correct me later.
Yeah.
So this is one rolling period. So like that, you take 260 points. Like second rolling would be 2nd January 2019 to 2nd January to 2022, and like that you calculate 260 days and you calculate the average of that. That is it.
Absolutely right. Absolutely right.
Fine.
That's exactly it. And only slight change I would say to what you said. When we
Okay.
calculate 260-day periods, they may
Okay.
not necessarily mean 1st Jan to 1st Jan. They might mean 1st Jan to 31st or 1st Jan to 3rd Jan, depending on the year, right?
Okay.
But
That
we
is
don't match calendar dates because that can become different number of dates, and therefore the return periods are not the same, and then that defeats the purpose.
Okay.
So we always do 260 working days, Monday to Friday, regardless of holiday.
Right. That is understandable. I just wanted to know basic how it is.
Yes,
Fine.
yes, that's exactly how it is. Every day we move forward and look back for 260 days.
260 was and take the
Yes.
average of it. Right?
Yes.
Fine. Thank you, sir.
Okay, no problem. So there are some questions we may not be clear about what you're asking. Could you maybe unmute and ask whatever your doubts are?
Yeah, I still did not get it that what is rolling window and how it is working in the period of 28th March 2019 to 1st June 2023. How it is exactly working.
Sure,
260 days.
understand. To explain that, Prajakta, let's just click on quant large and mid cap fund, because this is a page where we are doing rolling returns of many funds. But let's just look at the rolling return of one fund, right? And then that's just that's many funds together. So and Prajakta, also take out on the chart, take out the 520. That's fine. Leave the date is fine. Yeah. Take out the this toggle off the 520 and 780 day in the chart. Yeah. Okay. So basically here, what we're doing, so Prajakta, come to the absolute first point of the chart. Yeah. So 13 December 2011. On this day, this fund, we look back 260 day and calculate what the return was. That was minus 19.68. Then what we do is on the next day, 14th December, we do the same thing. I mean, it's hard to get to that point, but you see what we are saying. As you move forward in time, every single day, we look back 260 days, calculate the return and save it. And we keep doing this as we move forward through time until today, right? We save all the total of the 260-day return every single day. When we do that, we get this chart. Now, this chart shows you how the 260-day periods have performed as we move forward through time. That's what a rolling return chart is showing you. So is this clear so far?
Yes, understood.
Okay.
Yeah.
So
Thanks.
then what we do is we go further. Now that we've got this chart, then we wonder how how many what kind of expectation can we have for this number? In this chart, in fact, you can see on the x-axis, sometimes it is negative, maybe, I don't know, 20-30%, and sometimes it is positive 50-60%. So, what conclusions can we draw from this? So basically, we can say sometimes, you can see the stats here, it can go as bad as minus 30% in 260 days. Now, that's quite a horrible return. And sometimes it's an incredible return, where in 260 days, it is made 110%, right? Now, one thing we can do is, why don't we take an average of all these numbers? So we get 18.33%. So we say, okay, on average, any 260-day period will typically give me 18, but you can see the variability is quite high. So the volatility is 20%. So it's showing you can be down, you can be up. But so here is what we do is we analyze them further and further. And in the compare section, Prajakta, let's go back. This same analysis we have done for multiple funds in one go.
Right. Okay. So in this, we can see there is statistic point-to-point return, and there is another option also. Can you please elaborate on
Here,
that?
absolutely. So here, my strong suggestion is that you use simple returns for rolling analysis. We've had some suggestions from users who wanted to use point-to-point as well. This relates very simply to how we calculate the return of the 260-day period. So in the while we were going through in the other tab, that on this day we look back to 260 days and calculate the return. Question is, how do we calculate the return? Because calculating return also has 2-3 methods. So the simple return method, what it does is it takes every daily return period and uses that, takes an average or adds it up for the annual return. There's another method of return which is usually used in performance analysis, which is to take the start point and the end point and just do end point divided by start point minus 1, right? That is the point-to-point method. So a lot of people wanted to use the point-to-point method. The difference is not that much, but there is still a difference. So that is the reason we've got two choices: point to point or simple return. As I said, point to point uses the end period divided by start period, end price divided by start price minus 1. Simple return simply looks at each daily return and adds them up, and these two methods will not be the same. And the reason they will not be the same is that one includes the effect of compounding and the other does not. So whenever you use
simple return does not.
Simple return does not use the effects of compounding. And in our suggestion from NGEN is that you should not use compounding when doing research, especially in quantitative research, because you need to look at all periods free from the effects of compounding, because effects of compounding is not something you can count on. Using simple returns is a standardized way of looking at things. So for example, whenever you calculate Sharpe ratio, you can never use CAGR or anything else. You have to use simple returns in the numerator. That is actually in the definition of Sharpe ratio. So we always do that. Even in the performance tab, Prajakta, let's go to the quant large mid cap tab, that the one that you opened, and just go to performance. So here you might see annual simple return, the fourth one. This one is average multiplied by 260. So that's an average of daily returns, right? Below this is annual volatility, and below that is Sharpe ratio. So we do not use the CAGR on top, or even the total simple return on top, which is again used, calculated using start and end prices. We don't use them for risk-adjusted ratios or any kind of quantitative analysis. So our suggestion is to use simple, but if you still want to use point-to-point, that is also available.
So for calculating this Sharpe ratio of 0.33, what
Yes.
exactly we have taken as in the return of this particular fund? We have taken
We have
13.45 or what we have taken?
13.45 minus risk-free
Minus
rate divided by
the
annual
standard
volatility.
deviation, volatility.
Yes. Yes.
Okay. So volatility is also taken on the basis of simple
Absolutely.
calculation
It's
for.
well, volatility will always be simple anyway because it is calculated as a standard deviation of daily returns. This is another reason why sometimes you will find our stats to be different from what you might see on an AMC fact sheet or some other platform, is because our volatility is always calculated using daily prices, daily returns. And that is incredibly important. If you use monthly returns, you're describing an entire year using only 12 data points, and that is not enough. So we always use daily return. And if you ever have any questions about how something is calculated, we can always, we actually send you back Excels, which has the exact calculation in Excel, which matches the platform. So
How can we get that?
I mean, obviously we do it on a case by case basis, but if there's any particular thing you're looking at, you can write to support@engineresearch.com, tell us the name of the fund, send us a screenshot, and just maybe circle that I want to see on Excel how, total simple return is calculated, CAGR is calculated, annual simple return is calculated.
Okay,
And we will do
understood.
that for you. So you can match and you can be comfortable that what you're seeing here is correct.
Right, thank you. On this fund performance only, can I there is the start date, right? 14 December 2010. If I
Yes.
make it exactly 1 year ago, one
Mm-hmm.
year ago, right?
Yeah.
So there you can see 11.92% is the return in 1 year, and in
Yeah.
CAGR I can see 11.35 or 11.47 or 11.98 if I talk about total simple. So all of these
Yes.
numbers are changing. So what exactly have we taken for 1 year? Is it because of the date?
No,
Uh,
so it's only because of time periods here. So if you go on the question mark here,
hmm,
so total, you can see, I mean, this is obviously start to end point. So even if it's more than a year, etc.
yeah,
Now this is the total return calculated by the sum of the daily returns of the data series, right?
right.
So, and CAGR, you can see that's a standard CAGR formula, right? These are just, mathematical facts. I mean, obviously what happens is when you do 1 year ago, what did it pick here? It picked, 3rd May. So just because of a 1 day difference between annualization or 260 or 261, you can get small differences. You can also see that total simple return is also, annual simple return is also again different, right? But this is quite
Hmm.
simply, just go on the question mark. This is the average daily returns times 260. So the reason you're getting slightly different answers here is because of the difference in various different ways of calculating return. Unfortunately, I mean, there is no one method, and so we want to be clear and show you all of the results in front.
So I think none of these is matching with 1 year 11.92%. I think this might be because system is getting 1 year exactly from 1st June or
Yes,
2nd June.
yes, that
Okay,
is right. That is right.
right. Okay.
Yeah. Yeah.
Sir, can you hear me?
Yes, please go ahead.
Sir, my question is when I take a PDF from the report, sometimes the benchmark is not coming for the report, sir, the column.
Yes. Okay. So, no, you're right. So basically, we recently added this benchmark column. It was not there before.
Yeah.
So this is under process, and we are aware of the fact that when you print the PDF, only the first column comes.
Yeah.
The second column is not there.
Yeah.
So this is under process. So just give us a few days, sir, and I mean,
This is a
definitely
couple
this
of
month it will
This
happen.
is a couple of weeks. It is going, sir. Not only 1 week or 2 weeks. This is,
Yeah.
it is one time, couple of months, I think.
Yes, sir. So we've actually just finished quite a lot of new feature updates. We will be sending out an email about that in a day or two anyway. But this one is definitely up next, coming up next, the benchmark to be added to the PDFs.
Okay, fine. We can expect this month today itself. I mean, June.
This month, the month of June for sure.
Yeah. Okay, fine. Thank you.
Hello.
Go ahead, please.
Yeah, if you can go to the rolling return section,
Yeah.
there at the bottom, if you see the probability, weighted probability.
Yes.
When you take a printout, it doesn't come.
When you take a
Printout in the
printout,
sense, the Excel sheet. For example, you can click the Excel.
okay.
Check whether it comes or not. Let's see.
Acha, it's
Doesn't
not
come.
there. Okay, Prajakta, let's write this down. It's a bug fix, so we can probably get that done soon. Thank you for pointing that out. So we will definitely make sure that comes in.
One suggestion, sir. Whenever
Yes.
you know you are making a comprehensive and a very excellent quality research platform, but whenever you add or delete or you enhance something, try
Yes.
to validate and whether it is user friendly, customer friendly, and whether it is giving that populated result or report mechanism.
Yes,
Just like
yes.
in the case I showed. So if
Understand.
the people who are at the research level or the programming level, if they can check this.
Absolutely,
it would be good. I understand that they must be working continuously. Sometimes small things may slip out, but
yes, it seems this is obviously one of them. So we will definitely get this fixed.
yeah. So this is not coming. Likewise, there could be many, but particularly
no,
this
we will also have a check through also, sir.
Yeah, because you added this. See, all along this was never there. So the
Yes,
moment
sir.
when you added this, it was much easier for you to check whether it is does it come in the print or not.
Absolutely, sir. In fact, I forgot the name of the client, but one of our existing users only suggested this weighted probability.
Yeah.
So
It's a good thing you have done. This is a very good thing you have done.
yes,
but it
sir.
doesn't come.
And yes, sir. And as we said so many times before, we are a user-driven development platform. As I said, nobody in NGEN research thought of the weighted probability return. It's actually one of our users who called us up and said, "How about this? Why don't you do this?" We thought the idea was great, and we put this in. So
one more thing I just wanted to add is
yes, sir.
you have this excellent drawdown mapping.
Yes, sir. Yes.
Yeah. So there is a ratio called as Martin's ratio. Ulcer index. It is called as ulcer index.
Okay.
So it is nothing but it plots these three parameters: the size, length, and the recovery.
Okay.
And the ulcer index, this was founded by J. Martin.
All right.
This was ULCER, ulcers index.
Yes, sir. I already found it online. Please go ahead, sir.
Yeah, that is an excellent thing. So it looks at the downside of the scheme written in a very macroscopic manner, and it gives you the final figure as a ratio.
Understand.
And
okay.
Even going further, there is one thing called as Martin's index or Martin's ratio.
Yes, sir.
So if you can go there, if you can go look at it, it will be
definitely, sir.
It will enhance your research capability.
Absolutely, no, definitely. So these are
You just have to see, just like you have put that weighted probability.
Yes,
in
sir.
the same fashion, you can put in the before the worst drawdown, you can put the ulcers index or the Martin's ratio.
Yes.
As a column.
Perfect. So Prajakta, let's write these two down: Martin ratio and ulcer index.
Yes,
that
sir.
seems definitely worth looking into.
Yeah.
Perfect. Thank you so much, sir.
Yeah. One more thing I just wanted to ask. You are Arnab, is it?
Yes, sir. Arunabh Mukherjee.
Yeah, Mr. Arnab, I just wanted to check with you.
Yes, sir.
You have the white labeling in the customized thing, not in the second thing, is it? There are three pricing.
Yes. Well, we've actually recently stocked the basic platform. So we currently have only two. One is, you can check on our side. One is the light, and the other one is the premium. So the light version does not have, co-branding.
Okay, so my request is if you can also include co-branding or the white labeling in this, that would be fine. This is my request.
Yes, sir. I mean, I'll probably check with Dave about this. So maybe he will make the decision for something like this. But I will definitely check.
That would be really helpful for a lot of MFDs.
Understand,
like me.
Understand, sir.
Right?
Yes, sir. Yes.
So I look forward to a favorable thing on that.
Yes, sir. So we will get back to you on this definitely. So, Prajakta, please just note that point.
Yeah. And look at that ulcer index, sir. Ulcer index.
Definitely, we'll definitely look at it. We'll definitely look at it. Yes, sir. Yes, sir.
And otherwise everything is comprehensive. You have done extremely good.
Thank you.
Not an issue. So only the thing is the color combination of the platform is a little jaded. Just the green is a jade green.
Yes, sir. We tried to not make it too bright. We thought it make it a little boring and serious work. I'm not
saying go for a brighter one or this thing.
Yeah.
But if whenever you get time and spare a person some time, probably you can fiddle around and experiment to come out with little pastel shades.
Absolutely, sir.
Not many, a couple of them.
Yes, sir. So here, by the way, just so you know, in the settings section, you have a colors area. You can, Prajakta, let's just change the color to anything random. You can show it right now. You can just click on change. Okay, so the top is
only the top changes.
So the other things also change. So you can basically change the entire charting scheme. There's so many charts everywhere. You can actually we've given you 3 preset themes here, but you can actually create your own theme and save it. And once you do that and you run analytics again, even your charts and your PDFs will actually open. I think you may have to run something again, or maybe even relog in. I'm not sure, but let's just see. So you start seeing the colors. See, you can see now the colors have changed. So there are some customizations available, but I get your point. We can look at also adding more.
See, you have given the option of choosing the color. That is also absolutely fantastic. But and now we have gotten used to this jade green kind of layout. But
yes, sir.
You can go for the white background and the black font is all good.
All good. Yes, I know, sir. Yes, sir.
Yes,
sir. Perfect.
Absolutely fine.
Thank you, sir.
Fine. Right, but ulcer index and Martin's ratio.
Definitely.
Earlier the better. And that weighted probability in the print section.
That will be fixed for sure.
Yeah. Thank you.
Perfect. Thank you. I think there was one question on the chat saying in the fund performance, there's a rebalance tab. Projector, just look at any fund.
Yeah, in the fund performance, there is rebalance tab, right? There is fixed or something mentioned over there.
Oh, achha, that's for portfolios. Okay. Yeah.
Yeah, for portfolios.
Yeah. So basically what this means is, obviously this is a back test. So there are these 12 funds and this rebalance tab basically lets you change the method of calculation of the backtest. Again, we strongly suggest that you use fixed weights, but if you do want to try other methods, what this basically does is, this is obviously going back to the start date, which happens to be 2018, starting with those weights that you see on the top, 22%, 18%, 13%, etc. And then moving forward in time and showing you the performance of this portfolio. Now, as it moves forward in time, obviously after, let's say, 1 quarter, the value of your investment of 22.73% in Kotak Flexi Cap would have changed because the fund would have gone up or down. versus other funds. Obviously, if every single fund in your portfolio moved up or down in exactly the same way, in that case, your weights will remain the same. But generally speaking, after a few months, your portfolio weights will be slightly different. And it can make a big effect over time. So what we do is when we use fixed weights, we assume that over time, your weights are fixed and they are not being changed as we calculate the backtest returns. But in other some of these other options, for example, let's say quarterly rescale, what this does in our backend calculation is whenever you run a quarterly rescale option, it will start on 2018 with 22.73, 18.18, etc. 1 quarter later, it will basically rescale the weights back again, but it will wait for 1 quarter before rescaling it. And then
So
next
one
quarter
quarter
again.
rescale will be on the basis of return of that 1 quarter, or it will be just on the basis of the investment that we do accordingly?
So it will be on the basis of how much the portfolio weight has changed as a result of the movement in the fund price.
Right. So
Right.
return basically.
Yeah, return. Yes, return.
Okay.
Right.
Understood.
And for example, there's another option here which basically says leave, I think leave invested. This is saying 5 years ago, I will put this portfolio on and then I will just leave it. I will not scale, rescale anything. Right. I will just see what happens. Right. No scaling. And by the end, by today, 3-4 years later, 5 years later, it could be that your 22.73 Kotak is now worth 26 because Kotak has done better than others, for example. Right. So this is that option. But generally speaking, for research purposes, fixed weights is what the vast majority.
So isn't fixed weights and leave invested same?
No, fixed weights
As in, even if the
Okay.
return is there, I will make sure that Kotak Flexi Cap has 22% only.
Exactly.
Every time.
Exactly. Okay. That is what fixed weight is. And leave invested is saying, I don't care.
Understood.
Yeah.
Yeah. Okay. Thanks.
So, just another question.
Sure.
So there was a suggestion regarding the rebalancing only. So what I wanted is like, can we have something like when we upload the client's portfolio in your portal, right?
Yeah.
So I just if like he has a large cap fund, large and mid cap, so they have their particular allocations in it, like large as 80%. 80% of this is in large cap and 20 is in mid and others in small. So can that kind of bifurcation be done if we just put in the amount? So it would be easy to do later, like when we change, like when we sell or buy or something, do like that. So can something of that platform be made? Like,
so you're saying you upload the latest portfolio of your client,
yeah,
right?
and where he can reject the portfolio there only, like buy and sell, we can do there only. Can it happen?
Well, there is one there's kind of a way of doing it. So, firstly, when you say large cap, small cap, do you mean underlying exposure or do you mean fund classification?
Yeah, suppose
Underlying exposure?
Mirai asset large cap fund, suppose it is. So it has around about a allocation of 80% in large and 10 in 15 in mid and others in small. So like out of 1,80,000 gets invested in large and 15,000 in mid and another 5,000 in small.
Okay. Right. So okay.
Yeah.
So in that case, Prajakta, just come back to this chart for 1 second. Just come back to this chart only. Yeah. So in that case, we should look at exposure. So Prajakta, come to the concentration tab. So here, this large mid caps, and let's do percentage of equity. So we can forget about the rest. So here, basically, you can see 62.31 large cap, etc., right? These are based on the underlying stocks that you have exposure to because of the mutual fund. Now, yes. The one way that you can do what roundabout way I was saying is, Prajakta, just edit the portfolio, right? So what you can do is obviously edit this, change the weights, and you'll have to run it again and see what you get here. That is the only way I can think of that you can try to kind of change your large cap, large, small, mid, etc. Allocation while changing it. So you don't even have to update it, you can just run it. And once you're happy, you can save it. But so for example, we've changed some weights here. We go back to concentration, make it percentage of equity. By the way, this, if you go to the setting section, you can set it to percentage of equity at all times. So there's a setting there.
Actually, it doesn't solve my question, but
Yeah.
can I have a personal call there? I'll just show what I have on Excel, and then
Right.
maybe you can get that on engine. Then that would be very helpful. What I'm saying.
No problem. If you send us, if you send us what you've got on support@ngenresearch.com, we'll check it.
Fine. I'll connect with Prajakta, and maybe I can get your number and we can just have a chat about it.
Perfect.
That is fine.
Sounds good.
Fine.
Okay. Thank you. Is there any other questions? Please let us know in the chat or just unmute.
Sir, still I don't get understand that the rebars. Can you repeat again, sir, once again?
Sure. So here basically it just shows you how you're running the backtest. So in the fixed weight case, as we move through time, obviously you can see the blue line here because we are moving through time and you're seeing the return as we are gaining or losing. We keep the weights, portfolio weights constant. So 34.37% in HDFC small cap will always be 34.37. Even if HDFC small cap goes really, really high while the others are flat, even then the percentage holding will be kept fixed.
Okay.
In let's say the quarterly rescale option, what we will do is we will let the 34.37 change because of the change of return coming from one fund versus the other.
But sorry to interrupt you, sir. But the
Yeah,
percentage is same. But the percentage is 34.7% only.
Yes, correct. But you imagine a case where let's say you have a simple portfolio of 50% each, right? One fund goes up 10% and the other one is flat, right? Your one investment of 50 will become 55. The other one will still be 50.
Okay.
So you will end up with a portfolio which is 55 and 50. Now 55 is not 50% of 105 anymore. Your total portfolio has become 105. So your percentage allocation, which was earlier 50% and 50%, has now become something like 52 and 48. So over time, as the price of one fund increases while the other one does not increase as much, that portfolio weight will start to become bigger, right? So the 34.37 will not be 34.37 10 days from now, 15 days from now. It will be slightly different because obviously HDFC small cap will not move in exactly the same way as Kotak will. If HDFC small cap is doing badly versus Kotak, then HDFC's allocation will go slightly down while Kotak's allocation will go slightly up because the value has changed. So your real portfolio, when you measure it 1 month later, 10 days later, and you calculate the percentage based on the latest values, it will not be exactly what it is here.
Yeah,
that is the reason we have to rebalance.
But the quarterly rescale, annual rescale, that's I didn't get you that. What is the meaning for that? The portfolio changing, or turning?
So basically, we know that the portfolio will change in percentage allocation over time, right?
Okay.
Now, so in the fixed weights option, what we do is we force it to not change. Yeah.
Okay. Fixed.
Right? We fixed it, right? Now, in the quarterly rescale option, we let it change up to 1 quarter. When 3 months go by, we bring it back to 34, 37, 15, 63. Then again, we let it go.
That means you are talking about top up, the percentage of the fund top up?
Yes, so we basically rebalance the portfolio.
That means they increase the portfolio. I mean, the percentage of the, for example, HDFC small cap, in the fixed rate is 34.3%, and the quarterly we increase the investment with 35 or 30%. Then.
Yeah. So if it has gone up, let's say the 34, 37 has become 35, right? Then in the rebalance, quarterly rescale, every quarter it will be reduced back. So in real life, what will happen is if you bought HDFC small cap and you bought Kotak Flexi and HDFC small cap goes up a lot, then your percentage allocation in that is increased. So what you need to actually do is sell a few units of that fund to bring yourself back to the percentage weight that you thought you would be at.
So we have to do the quarterly recycle or the portfolio rebalancing.
Well, generally speaking, you should be, because let's say if you've told a client that let's do 40% in this fund, 30% in this fund, 30% in this fund, and you do it, right? You do it. 6 months later, it will not be 40, 30, 30 anymore. 100% it will not be, right? It'll be 41, 28, 31, something like that. So you have to then check and see, oh no, my 40 has become 41, so I should sell 1%. Right? Come back to 40. That is your rescaling or rebalancing your portfolio back to what you want to be at, which is 40, 30, 30. If you don't do that and you leave it, it will become something nobody knows.
Okay.
Right? So that rebalancing process is important for you, which is separate from NGEN Markets anyway. You should be doing that in your business anyway.
Okay.
Right?
Okay.
Unless you're happy to let it go anywhere. Right? Because as I said in the 50-50 example, one fund has become 50 from 50 lakhs, it has become 55 lakhs. The other fund from 50 lakhs is still at 50 lakhs. Now your portfolio is from 1 crore has become 1 crore 5 lakhs. But the first fund, which you wanted to be only invested 50%, you're not 50% anymore. Because for 1 crore 5 lakh, 50% will be 52.5 lakhs. But you have 55 lakhs in it now. Right?
Okay,
so,
understood.
Yeah. So what do you have to do? You have to sell 2.5 lakhs from the first fund and buy 2.5 lakhs in the other fund. Then you will be 52.5, totaling to 1 crore 5. And now you're actually back to 50-50 again.
Okay, understood. Thank you. Thank you so much.
No problem.
Mr. Arnab.
Yes, sir.
Hello.
Yes, sir.
In this, your rebalancing parameters which you have put.
Yes, sir.
Would it be a big issue to put efficient frontier in that?
So we can have a look at it. We haven't, created any models or any kind of front end to show you an efficient frontier. But generally speaking, efficient frontier will show you various different risk and returns, effectively sharp ratios, to get a good idea of,
because that is a big exercise by itself.
Yes, it is. Yes.
But if you want to backtest it, you can backtest it with the multi-asset allocation.
Yes, sir. Yes, sir. That's right.
That would be a very good starting point.
Yes, sir. Yes, that's right. That's right.
So I mean to say, in the same rebalance, efficient frontier one tab can be there in what you are trying to do. But
yes,
it
sir.
is a huge exercise. It's a huge exercise, and there would be different category of funds or mix of funds which you need to then mix and match.
Well, yes, exactly. And here we are backtesting a specific portfolio. So it will be hard to do that. Yes.
So at a low volatility, trying to match something, because this I'm trying to say in the wake of the latest indexation benefit going away, that 35% to 65% equity coming into picture.
Yes.
And therefore, trying to be at the low end of the single, at the high end of the low end of the single digit volatility, but at the high end or low end of the double digit returns. Lower on the volatility, but higher on the returns, specifically in the balance advantage or hybrid kind of or multi-asset kind of categories.
Correct. That's right.
That 50-50 kind of balance hybrid funds are not there. So
no.
So this is a little precarious situation.
Exactly.
But probably having put a seed of thought, you can see how it can come into your future in this platform.
Yes, sir. We will definitely check it.
Right, sir?
Thank you, sir. Thank you very much.
Thank you.
Any other questions? Please let us know. Okay, if there is nothing else, Prajakta, we can close for today.
Yes, sir. So thank you everyone for joining in. We have noted down your feedbacks. We will definitely, if you have any questions, you can definitely write it on support@engineresearch.com. Other than that, let's say you want to have a look at the recorded webinar sessions, you can directly head over to our YouTube channel, NGEN Markets. We upload all of our webinar recordings there on a very regular frequencies. You can see all of the webinar past recording sessions are already uploaded. You can also see, in addition to that, some shorts, some 153 odd videos. You can definitely go through it and have a look at these also. So thank you so much for joining and have a great weekend ahead. Thank you so much.
Till when will this today's webinar get uploaded on the website? Can I know?
So next week, by Wednesday or Thursday.
Wednesday or Thursday. Okay, it will
Next
be
week.
uploaded on the website, so we can check the videos.
Yes, our YouTube channel.
Okay.
Yeah.
Okay.
The
Thank you.
link for it you can definitely find when you log in. There's already a YouTube button, so you can just click on it and access it.
Sure. Thanks. Got it.
All right. Thank you. Thank you so much.